In the third quarter of 2025, something extraordinary unfolded quietly in the global financial system. An event so strategic and discreet that almost no one in mainstream media noticed it until the data appeared months later. Chinese billionaires, some of the most influential and well-informed investors on the planet, began unloading massive positions in US stocks and moving $47 billion directly into physical gold holdings. This capital didn't move into cryptocurrencies, it didn't flow into bonds, real estate, or safer sectors of the stock market. It flowed entirely into solid gold stored in vaults across Hong Kong, Singapore, and Switzerland. The scale and direction of this movement were unprecedented, and anyone who understands the psychology of elite money should immediately recognize that billion-dollar decisions don't happen impulsively or without deep intelligence. The last time Chinese investors pulled capital out of the US at this scale was in 2007, months before the financial crisis detonated and destroyed $8 trillion in American household wealth. Back then, Chinese selling totaled $31 billion over several quarters, and experts brushed it aside as simple profit-taking. Yet within 18 months, Lehman Brothers collapsed and the S&P 500 fell 57%. Today, the movement is even larger, $47.2 billion in one quarter alone, the biggest quarterly exit by Chinese nationals since tracking began in 1998. And for those who study patterns, the message could not be clearer. The funds didn't just disappear into cash, they were meticulously redeployed into gold. $28.3 billion in physical bars and coins, $12.6 billion in gold ETFs, and $6.3 billion into private vault storage outside US jurisdiction. That precision matters because ordinary investors buy gold emotionally, driven by fear or speculation, while billionaires accumulate gold strategically for one reason only: protection from systemic financial failure. Some of the most recognizable names in Asian finance executed the shift personally and at scale. Pony Ma of Tencent cut his US holdings by 40% and redirected $2.1 billion into gold. Jack Ma of Alibaba liquidated his remaining positions in Amazon and Meta and moved $890 million into gold, while Wang Jianlin sold his US portfolio completely and shifted $1.7 billion into vaulted metal. These are not novice traders gambling on market sentiment. These are individuals whose networks reach into intelligence systems, manufacturing hubs, banking institutions, and government strategic planning. What makes their actions so stunning is that just 1 year earlier, in Q3 2024, Chinese investors were net buyers of US stocks, adding $23 billion in exposure, signaling confidence in the American market. Now, only 12 months later, that enthusiasm has flipped into the largest capital exodus in modern financial history. A $70 billion sentiment swing that reveals an entirely different internal forecast. For 40 years, since China opened its economy under Deng Xiaoping, Chinese wealth has consistently flowed into the United States, treating US assets as the ultimate safe destination for surplus capital. Even during crisis periods, the dot-com bust, the 2008 meltdown, the COVID crash, Chinese investors continued buying, believing that American downturns were temporary opportunities rather than threats to the system. Q3 2025 marks the first sustained reversal of that 4-decade trend, an unmistakable signal that something foundational in the global financial structure has shifted and is no longer trusted by informed capital. When the smartest money in the world reverses direction after 40 years, it is not a trade. It is a warning, a siren that only a few people bother to listen to before history repeats itself violently. To understand the weight of this signal, we must look back to 2007, when Chinese selling began months before any public recognition of economic danger, long before CNBC or Wall Street analysts sounded alarms. At that time, everything looked perfect. Real estate booming, banks profitable, consumer wealth rising, and optimism everywhere. Yet beneath the surface, cracks were already forming inside the financial system. The Chinese selling pattern back then followed an eerily similar timeline. $8.2 billion sold in Q4 2006, $12.5 billion in Q1 2007, and $10.8 billion in Q2 2007, quietly, invisibly, without panic. Then the domino chain began to fall. Bear Stearns hedge funds imploded in June, credit markets froze in August, and by October 2007 the S&P reached its top at 1565 before collapsing over the next 18 months. From the beginning of Chinese selling to the bottom of the crash, the time span was 28 months, just over 2 years, an almost perfect window between insider exit and mainstream disaster. And now, in 2025, if this pattern continues, and history shows it often does, the implication is stark. The crash window sits between Q1 and Q3 of 2026, right when most investors least expect it. So the unavoidable question becomes, what do Chinese billionaires see coming that average investors cannot yet see? What signals are visible to them through real-time data and global intelligence networks? These individuals have access to early manufacturing data, shipping data, private banking intelligence, high-frequency capital flow monitoring, and geopolitical assessments that retail investors will never access. They are responding not to headlines, but to internal metrics pointing to structural risk, slowing corporate orders, strained debt markets, and growing instability beneath the global financial architecture. The silence with which they made these moves should frighten anyone who remembers 2007, because smart money exits quietly, while the crowd keeps celebrating the illusion of safety. By the time retail investors notice, the doors are already closing, liquidity evaporates, and panic selling begins, turning controlled decline into catastrophic collapse as history has shown time and time again. Right now, in late 2025, the exit has already started, the clock is already ticking, and the world is watching without realizing what it is seeing. To understand why Chinese billionaires are exiting the US market, you must look at the three primary intelligence pipelines they rely on: manufacturing data, banking data, and government-level strategic intelligence. Chinese manufacturers control the production of the majority of goods shipped to US corporations, including electronics, servers, and components that power the infrastructure of the AI-driven economy. When orders begin to shrink at the factory level, Chinese executives see the decline months before it appears in American corporate earnings or GDP reports, and they relay that information directly to the billionaires who own them. According to the China Semiconductor Industry Association, orders for AI-related chips dropped 22% in Q3 2025 compared to Q2, the first decline since the explosive AI boom began in late 2022. That means Chinese manufacturers saw the downturn instantly, while American investors remain blind until companies like Nvidia, Microsoft, and Amazon report earnings, long after the damage is irreversible. So when insiders learned that hyperscalers canceled chip orders, they moved, without hesitation, selling tech stocks into strength before the slowdown became visible and rotating into gold as protection. The second intelligence pipeline comes through banking networks, where Chinese banks were counterparties to American financial institutions during the subprime crisis and saw credit deterioration before anyone acknowledged it. In 2006 and 2007, while US pension funds were still buying supposedly safe PAA-rated mortgage securities, Chinese banks were quietly exiting positions because they could see the real underlying loan performance data. That same pattern is happening again, as Chinese financial institutions track stress in US corporate credit, commercial real estate defaults, and the risk of systemic instability created by record levels of leverage. The third pipeline is government intelligence. China's data collection system analyzes satellite imagery of US ports, energy consumption patterns, industrial output, and capital flows in real time, faster than public economic reporting. Their intelligence apparatus detected the housing collapse before the Federal Reserve acted in 2008, and now it is signaling a convergence of structural risks forming around the US economy and financial markets. The reaction of Chinese billionaires to these signals is not emotional. It is strategic and disciplined. Their selling is slow, controlled, and designed to avoid panic while repositioning billions quietly. When the smartest money moves silently, it means a storm is coming. When billionaires convert equities into gold, it means they are preparing for systemic disruption, not a temporary correction. Consider that the US is now dealing with a national debt of $35.7 trillion, an economy with a 130% debt to GDP ratio, and deficits expanding faster than any period outside wartime. For context, Japan reached crisis when debt to GDP hit 120%, Greece collapsed at 180%, and the US is rapidly on track toward those levels while interest payments alone approach $1.3 trillion per year. Chinese investors study historical currency collapses, sovereign debt failures, and reserve currency transitions meticulously, and they recognize the same warning patterns emerging in the American financial structure. They also understand something the average investor overlooks: the weaponization of financial assets. Since 2022, the US has frozen $300 billion in Russian reserves and imposed sanctions that reshaped global capital strategy. If the US can freeze Russian assets instantly, Chinese elites assume it could freeze theirs as well, especially as geopolitical conflicts and technological rivalry intensify between Washington and Beijing. With that risk in mind, gold becomes the ultimate escape route, a form of wealth without counterparty exposure. No bank, no government, and no regulator can seize gold held offshore. Gold functions as the final layer of protection when trust in financial institutions erodes. Unlike equities, bonds, or real estate, it requires no third party to validate its value and cannot default. Throughout every major collapse in monetary history, Weimar Germany, Zimbabwe, Argentina, and Venezuela, gold preserved purchasing power while paper currency imploded and savings accounts evaporated. That historical consistency explains why wealthy investors always rush into gold before crises reach the public consciousness, while retail investors ignore the signals until devastation is unavoidable. Gold's performance during the 2008 crisis shows the pattern clearly. In March 2008, gold traded around $920 per ounce, and when stocks collapsed 57%, gold remained stable and then doubled to $1,894 by 2011. During the COVID crash of 2020, gold rose from $1,580 in January to $2,075 in August, while the stock market lost a third of its value and panic liquidations created chaos in global markets. Now entering 2026, gold sits around $2,650 per ounce, and if this crisis mirrors past patterns, gold could rise to $3,200, $30,500 during the crash, and $4,000 to $4,500 during the recovery phase that follows. Chinese billionaires understand this cycle intuitively. Sell early while valuations are inflated, move into gold before demand surges, and wait until fear reaches its peak before re-entering the market. That philosophy has created extraordinary wealth for insiders historically, from Jesse Livermore in 1929 to Julian Robertson before the dot-com crash to Chinese elites before the 2008 collapse. But the most important element of this transformation is the timeline. Crashes do not happen overnight. First the smart money exits, then institutions panic, and retail investors always sell last at the bottom. Right now, we are clearly in wave 1, the quiet phase where billionaires move stealthily without disturbing the market, selling into optimism rather than reacting to visible chaos. Wave 2 triggers when institutions are forced to sell into falling prices, creating a chain reaction and liquidity spiral that transforms decline into a full-blown crash across global markets. Wave 3 arrives when retail investors panic, dumping assets out of fear, locking in catastrophic losses, while the same insiders who sold early begin accumulating bargains at half price. As of late 2025, we stand in the early stages of Wave 1. The exit door is open now, but it will not remain open for long. History rewards the prepared and punishes the late. The reason Chinese billionaires are shifting aggressively into gold is not because they fear short-term volatility, but because they foresee structural shifts that could reshape the global economic system permanently. They see 4 converging risks forming a perfect storm: the slowing of the AI-driven economy, an unsustainable US debt trajectory, increasing geopolitical asset seizure threats, and the accelerating decline of the US dollar. The first warning signal comes from manufacturing demand tied to AI infrastructure. The AI boom fueled record spending on chips, servers, and data centers, pushing valuations in tech stocks to historic extremes. But when orders began collapsing in Q3 2025, factory owners across Shenzhen and Guangzhou alerted investors that hyperscalers were canceling bulk purchases, signaling the first cracks in the AI growth narrative. Those order cancellations are invisible to the stock market until earnings reports reveal them publicly months later, which means Chinese manufacturers saw the slowdown long before Wall Street even sensed trouble. At the same time, the US government is approaching mathematically irreversible debt levels. With $35.7 trillion in national debt and interest payments larger than the military budget, sustainability is collapsing. Debt to GDP is now 130%, a number associated historically with default restructuring, rapid currency degradation, and emergency intervention, not with stable expansion or normal financial functioning. Chinese billionaires have studied sovereign collapse patterns closely, watching Japan in 1989, the Asian crisis in 1997, the Eurozone crisis in 2011, and understand what systemic exhaustion looks like. They also understand that the geopolitical environment has changed dramatically since 2022, when the US seized $300 billion in Russian assets overnight, rewriting the rules of financial safety. That event demonstrated to global elites that assets held within the US financial system can no longer be considered inviolate, and that politics can override property rights instantly and without warning. For Chinese billionaires, that risk is not theoretical. Many have direct exposure to US markets through equities, real estate, and corporate holdings tied to industries now under scrutiny. And when fear of asset seizure intersects with fear of systemic collapse, gold becomes not just an investment, but a survival instrument, a shield against uncertainty that transcends currency and geography. Unlike stocks, gold has no counterparty dependence. It requires no central bank, no government protection, and no corporate integrity to preserve its value through crisis. In every major currency crisis, from Weimar Germany to Venezuela, gold was the one asset that maintained purchasing power, while savings accounts evaporated and currencies were destroyed. In America's 2008 collapse, gold doubled while stocks halved. In the 2020 crash, gold surged while equities plunged violently, proving once again that gold moves opposite chaos and thrives on fear. And now in 2025, the environment is even more supportive of gold than in past collapses, because central banks are aggressively buying record tonnages to reduce dependence on the US dollar. In Q3 2025 alone, central banks purchased 337 tons of gold, the strongest buying impulse since 2022, with China adding 78 tons, India 42 tons, Poland 34 tons, and Singapore 28 tons. This coordinated accumulation creates a structural foundation for higher gold prices that didn't exist during previous crises, because supply is flat and new mining discovery is at a generational low. Mine production has stagnated for 5 years, and the world hasn't found a major new deposit capable of materially increasing supply, which means price must rise to balance availability and demand. When rising demand meets fixed supply, value accelerates rapidly, and gold's upward trajectory becomes almost mathematically inevitable, especially once institutional panic begins in wave 2. Most investors misunderstand the timing of capital flight. They believe crashes appear suddenly and randomly, but in reality, the collapse begins quietly long before headlines appear. Wave 1 is underway now, with billionaires exiting first while markets still look healthy, and indexes remain near highs, selling strength into investor confidence, not weakness into panic. Wave 2 triggers institutional selling when losses become visible. Funds are forced to liquidate positions, redemptions surge, and automated strategies accelerate downward momentum. Wave 3 is the emotional phase when retail investors panic, selling at the worst possible moment, and crystallizing losses that take years or decades to recover. The crushing irony is that retail investors always act opposite to insiders. They buy euphoric tops and they sell catastrophic bottoms, repeating the same psychological cycle forever. Right now, the window is still open to reposition intelligently. The exits have not yet clogged, the crash has not yet begun, and the opportunity to prepare still exists quietly in plain sight. Those who act during Wave 1 avoid the carnage of Wave 2 and Wave 3. Those who wait for confirmation will be destroyed by the speed and violence of the liquidation once momentum turns. This moment separates the prepared from the unprepared, the disciplined from the emotional, and the students of history from the victims of history repeating itself once more. We are nearing the point where markets begin to fracture publicly. When that break comes, it will be fast, shocking, and irreversible for those still clinging to the illusion of permanent stability. And when the dust settles, the people who acted early will be holding cash and gold, while others drown in forced selling, margin calls, and collapsing portfolio values. The smart money has already spoken. Through their actions, not their words. Billionaires do not warn verbally. They move capital, and right now they're running for safety with urgency. The window to act is small, because once the institutional phase begins, liquidity evaporates and selling accelerates faster than most investors can emotionally process or strategically respond to. Right now, we are still in Wave 1, the silent stage where the smart money exits calmly and without attention, selling into market optimism while the broader public believes nothing is wrong. Wave 2 begins when institutional managers are forced to sell to meet redemption requests, triggering a cascade of liquidation that turns a normal correction into a violent, uncontrolled collapse. Wave 3 is the retail panic, when ordinary investors sell everything at the bottom out of fear, locking in life-changing losses while insiders begin quietly buying again at a massive discount. By the time that moment arrives, gold will already be significantly higher, stocks significantly lower, and the window to reposition advantageously will have already slammed shut. The smart move now is not to panic or abandon markets entirely, but to reduce excessive exposure to risky equities, accumulate gold, and increase cash reserves to prepare for opportunity. A balanced strategy focuses on capital preservation first and growth second, ensuring survival through volatility, instead of gambling on hope while structural risks intensify. A reasonable defensive allocation for the next 24 months includes reducing stock exposure to 30-40%, building 15-25% gold holdings, and holding 20-30% in cash for future buying opportunities. Gold can be built through physical metal, ETFs, or mining stocks, but physical gold offers the strongest protection because it carries no counterparty risk and cannot be frozen or seized. Cash offers flexibility, allowing investors to buy the eventual bottom rather than becoming part of the herd that sells into capitulation and watches their portfolio bleed out. This approach is simple, practical, and historically proven, and it mirrors what Chinese billionaires and legendary investors like Buffett and Burry are doing right now. When billionaires move billions into gold and sit on record cash reserves, they are not guessing. They are positioning for events that ordinary investors do not yet understand. They see what is coming before it appears in headlines, before fear spreads through the market, and before the world realizes that stability was already gone, long before collapse arrived. History always follows the same rhythm. Insiders move early, institutions react late, and the public acts too late, creating the perfect opportunity for the disciplined few. Those who prepare now will not only survive the storm, but emerge with the capital necessary to buy world-class assets at prices that will never be seen again in our lifetime. Those who ignore the warning signs will repeat the fate of millions who lost everything in 1929, 2000 and 2008, believing it's different this time, until reality crushed the illusion. The question facing every investor right now is profoundly simple. Will you act while you still have time, or will you wait until you're forced to react when it's already too late? Chinese billionaires have already answered that question. They moved 47 billion out of US assets and into gold because they know what the data signals, not what the media claims. They were right in 2007 before the crash, and they are positioning themselves again today with the same urgency and precision that saved them billions while others lost everything. The pattern is unmistakable, the timing is familiar, and the consequences will be severe for anyone believing markets rise forever and risk can be ignored indefinitely. This moment will separate those who learn from history and act intelligently from those who dismiss the signs and become victims of the next inevitable financial collapse. When legends walk away from the table, it is never because they fear missing profits. It is because they see disaster forming long before the crowd recognizes it. Chinese billionaires are running for safety. Warren Buffett is sitting on $334 billion in cash. Michael Burry is heavily positioned for a crash, and the clock is ticking loudly. The only remaining question is whether you will listen or wait until headlines scream panic and markets plunge into chaos that nobody can stop once it begins. If you found this message valuable, subscribe to the channel, because knowledge is nothing without action, and time is running out faster than most people believe.